Thank you for joining us this morning. We are here today to hear from Polar Capital, who are here to talk through their half-year numbers to the end of September. We're going to hear from Gavin and Samir, and at the end there'll be the opportunity for Q&A. So please feel free to submit questions as we go along, or at the end as you see fit. Otherwise, without further ado, I shall hand over to Gavin.
Good afternoon, everybody, and thank you very, very much for coming into this this presentation on Polar Capital's interim results for the half year to September 2021. And perhaps just a very brief introduction as to what Polar Capital is. It's an active equities manager, 16 discrete autonomous teams, managing highly specialist differentiated portfolios for professional investors. So we don't approach the retail market directly. We effectively are providing portfolios and specialist funds for the intermediary market in the UK, across Europe, increasingly in Asia, and going forward in the US, and that'll come out of my presentation. So the legacy and the genesis of Polar Capital was a technology fund, which came out of Henderson just over 20 years ago, and the firm has grown from then. It IPO'd on the London Stock Exchange in 2007 and has been a quoted fund manager ever since. So I can then just turn to the overview and highlights for the 6 months we've just ended. And I think the context here is obviously coming off a lower base in the prior 6 months to September 2020. Obviously, the big sell-off that occurred around the lockdown and pandemic, we're coming off that base. But I think strategic progress has been made. We have recently launched a sustainable thematic equity team, so we lifted the entire team out. They will be based in Zurich in Switzerland, and that provides us with an additional £9 billion of capacity. Now, you'll hear me talk about capacity a lot because we are performance focused. We limit the size of our funds and the total amount of AUM the teams can manage to enhance and preserve performance. Key philosophy of Polar Capital's investment-driven culture. So we do talk about capacity a lot. The new team, we launched 2 funds for them. A smart energy fund and a smart mobility fund. Those are Article 9 funds in terms of the SFDR. And we're seeing very, very good early traction on those funds and a lot of interest from potential investors. Net inflows across our funds for the 6 months to the end of September was £690 million. Our sustainable emerging markets team, they joined us 3.5 years ago, summer of 2018. They've passed their 3-year track record now, and they've got assets under management in excess of £1 billion. So we've now got traction on that team going forward, and we've seen very, very strong flows in the 6 months, and of course following the end of the period in October and November as well. AUM grew 12% in the 6 months to 23.4 billion. The average AUM increased 53% compared to the comparable 6 months to September 2020. And obviously, that's a big driver of both revenues and core profit. Fund performance relative to peers is good. 99% of our assets under management in the top 2 quartiles since inception, 93 over 5 years and 74% in top 2 quartiles over 3 years. Very, very strong performance. Our focus is always on core profit. That's yielding results. So core profit in the 6 months increased by 65% compared to the same 6 months last year. And the core operating profit increased 23% on the immediately preceding 6-month period. In other words, a 6-month period to the end of March. So you can see very, very strong growth in core earnings. Balance sheet, Samir will come to a bit later on. The balance sheet strengthened during the period. So 140 million of cash and investments compared to 111 a year earlier, and obviously that's used partially for our seeding program to seed new funds. And of course, that increase in core profit has led to an increase in our first interim dividend, which has increased by 56% to 14p per share. Just to give you a bit of market perspective, I won't spend too much time on this. And the next 2 slides, Samir, that there is the global indices and the volatility over the period July through to October 21. You can see volatility on the left-hand side, the purple line That has come down over the period of time, so you can see less volatile markets. That's measured by the VIX. And you can see all other major markets have steadily increased all the way through, other than a dip in October 2020 around the time of the vaccine news. So you can see that's the environment in which we've been operating against those indices. In terms of fund flows, this is the source of this is Broadridge Fund File. This is pan-European equity sales and all asset sales, and you can see from this chart positive net sales every single month all the way through from October last year to September. So that's sort of the last 12 months. The light blue is equity sales, so you can see equity sales positive every single month all the way through. And interestingly, over that period, active equity sales has actually outstripped passive. And more recently, certainly the last 9 months, sustainable active has outpaced everything else. So that's really where all the funds are going, is into active, sustainable equity strategies. Although you can see from the September number there, we don't have October yet, but September you can see equity sales has come off slightly. And we think this is partially to do with investors' caution about valuations. And we can see from our private clients, they are increasing cash levels in their portfolios. So you can see slightly muted demand for equities more recently. I won't dwell too much on performance, other than I'll spend a bit of time on this slide and then move through the others quite swiftly. But this one really shows all the teams in chronological order of when they were launched. So you can see on the left-hand side of this chart, global technology, then healthcare, then income opportunities, all the way through to the right-hand side, our two most recent launches, smart energy and smart mobility, which have all of 6-week track records. So those were launched on the 1st of October 2021. But what that shows you is the outperformance, is the annualized outperformance against benchmark is the vertical bar above the horizontal line. That's the annualized outperformance since inception. The color of the bar indicates whether it's first, second, or third quartile against its peer ranking. So that's against the Lipper peer ranking. So you can see across the range, most of it's above the line, which means it's all beating benchmark since inception, and a lot of it's dark blue, which means it's all first quartile. You can see a couple, there's 5 in the second quartile since inception, and only 1 in third quartile, nothing in the fourth quartile. So fairly strong performance across the entire range. Just a note on smart energy and smart mobility, those two bars are in a different color. They do not yet have a Lipper ranking. They're too new to have Lipper ranking. So those bars there just show you their outperformance in the month of October relative to their benchmarks. A slightly different way of showing things. So this is first, second, third quartile rankings over 3, 5, and since inception. And this presentation will be sent out later. So again, interesting to look at. I won't go through too much detail now, other than to say very, very strong top 2 quartiles over 3, 5, and since inception. Of course, performance against peer group is important, but also performance against benchmark is as important, because obviously we compete against the passive funds, and you can see there, again, very, very strong performance versus benchmark over time. The technology funds have underperformed more recently. The reason for that is they were very defensively positioned coming into 2021. The team had the view that valuations were quite extended. They came into the current calendar year with cash in the portfolios, some NASDAQ puts, which is what they use to protect any downside in a big NASDAQ sell-off. And obviously that wasn't necessary. Tech continued climbing all the way through this year. More recent performance on tech, and particularly healthcare, that has improved markedly. I mentioned capacity earlier on when I was giving you the overview. This chart here shows you across our range, and this has been ordered top to bottom from those teams that have the most remaining capacity. So across the group, we currently have total capacity of 61 billion. And what that really means is we think we can comfortably manage 61 billion pounds and not in any way negatively impact on performance. Obviously, we are currently managing about 25 billion, so we've got remaining capacity of 38 billion, which is really what we see as the runway going forward in terms of what additional assets we can take on board with this existing list of teams that we've got here. The largest Current capacity is the sustainable thematic team, so smart energy and smart mobility at the top. That's £9 billion of capacity. That's literally just been launched. I'll talk a bit more about that team later on. Healthcare, you can see the dark blue is the current AUM that the team managed. The light blue is the remaining capacity. You can see they are not at half of their total capacity yet. Emerging market stars, which is where we're seeing a lot of the inflows. I mean, that team dominated inflows in the last 6 months, and certainly the last month and a half. That momentum has continued into that team. So they are sustainable emerging market managers. That's what they do. A fair amount of capacity left in there. Europe X Income, again, a lot of capacity there. Phaetian is the venture we have in Los Angeles managing international value. So we've had flows in the last 6 months, but you can see a fair amount of capacity remaining there. And that's primarily earmarked for the US investor market. So international is essentially MSCI ACWI, All World Companies Index, less US. So it's typically a US type product. North American, that's US and Canadian equities, managed here in London. Predominantly UK investors in that. You can see there's capacity there. European Opportunities was an acquisition we completed last year. You can see there about £4 billion of total capacity. They're currently using about 1.6 of it, so a fair amount of way to go. Technology is an interesting one. So you can see that's the greatest AUM of any team in the group, and as I said, that's effectively the heritage of Polar Capital, but relatively limited capacity going forward. The technology open-ended fund we soft closed last year, and what I mean by that is we stopped marketing it to new clients. And that always brings about a mild amount of redemption. So we're not backfilling any churn in that fund, and that's exactly what's panned out here with technology. So over time, you would expect technology concentration within Polar to actually reduce relative to all the other funds. As the others continue growing, tech will remain stable at its current size, and the others will catch up. Financials, a fantastic story there. That's come back into focus with the interest rate cycle changing now. Banks have really performed well. Financial sectors performed well, and we've seen demand for that sector, particularly the investment trust, where we've raised about £160 million of new share issuances in the global financials investment trusts. UK Value, also very, very good performing fund. It is also soft closed. What remains open is their all cap strategy, more for institutional clients, but they've had a tremendous run in terms of attracting clients into that small mid cap UK company space. Convertible team, that's the only team that does not manage pure equity, so that's convertible bonds. They've had a good run. You'll see later on when I show you the flows. They've had net inflows in the 6 months. Japan Value, again, better performance, relatively small. Allocations to Japan are not what they used to be 7, 8, 9, 10 years ago. Global Insurance doing well, and of course Forager is one of our very, very old funds, very small capacity. It's a European long-short fund within a Cayman fund structure. Very, very strong 2021 performance. That's the progression of our AUM since September 17. So you can see compound annual growth in AUM of 22%, all the way through from 10.6 up to 23.9. And on the 12th of November, 2 Fridays ago, it was 25 billion, maybe pushed by markets movements, but also net inflows in that period. So you can see a very good progression. A dip in March 2020, obviously that was the sell-off following lockdown caused by the pandemic. That shows you which teams had inflows on the left, so above the line on net inflows in the 6 months. So this is the 6 months to September. On the right-hand side, net outflows. You can see the majority of the teams had net inflows, all the way through from healthcare, mainly through segregated mandates on healthcare strategies. Emerging Market Stars was the fund with the largest inflows as a single fund. UK Value, you can see financials, Phaetian Partners I spoke about, Japan. And then on the right-hand side, you can see the impact of soft closing the technology open-ended fund is outflows because we're not replacing natural churn in that fund. The technology team managed around £10 billion, so it's around 45, 46% of the total AUM of the firm. And of that 10 billion they manage, 3.7 of that is in an investment trust, which has got an outstanding long-term track record. Moving on, I'm going to really point you to Samir now, more for the financial highlights of the 6 months. Then I'll come back to strategy update and outlook.
Thank you, Gavin, and good afternoon, everyone. So over the next few slides, we look at the financial results of the company, and we'll take a look through the P&L and results. There's a couple of slides on the balance sheet and capital position of the group, and then I'll round off with a look at our dividend policy. So really to talk you through the financial highlights for the first half of the year, to help you understand our P&L, there are three key lines of revenue or profits as we see them on our P&L. The first one is core operating profit, and that is essentially the net management fees that we charge for managing our funds, less the costs of running the business. And as Gavin's spoken about the average AUM having increased period on period, at the top of that slide there, you can see that increase of 53%, feeding straight through to our net management fee, which is also up 50-odd%. And that then, through being very disciplined with our cost base, allowed us to report core operating profits up 65% to 36 million for the first half of the year. Core operating margin up 3 percentage points to 39%. But I will flag our full expectation for the full year when I discuss the costs on the next slide. The other key driver of revenue is obviously performance fee profits. We do charge a performance fee on most of our funds. However, with the more muted performance that Gavin mentioned this year compared to last year, that line is much lower. It's nil for the September period end that we reported on just recently. But to also put into context on when the vast majority of performance fees crystallize through the year, out of all of the funds that we manage, we have one, the technology trust, that has an April year end. So any performance fee profits that we recognize and report on in our first half of our financial year each year only relates to that one fund. The vast majority of our funds under our usage range have a December point at which the underlying performance and their year-end closes. And therefore, in any given financial year, performance fee profits fall in the second half of the year. So when we announce our third quarter AUM in early January 2022, at that point, we will indicate to the market the performance fee profits that have crystallized for this financial year ending March 2022. However, the indications at the moment are that those profits will clearly be lower than what they were last year. The other and final driver of revenue and profits on the P&L is the other income line. And the best way of understanding that line is really that line represents a mark-to-market charge on our seed portfolio. So as our underlying funds do well, we do seed some of our new and nascent and emerging funds through our seed portfolio. And the gains and losses in terms of market value on those holdings feed through into the other income line. So last year, where the underlying funds did really, really well, we had large performance fee profits and a larger line representing other income. And this year, with more muted performance fee profits are likely to be lower, and the other income line is lower. One key message that I would like to pass on while we're still on the highlights page is that as a real key focus for the organization is growing our core earnings and allowing core earnings to become a larger share of our total earnings. And as that evolves over time, what that will allow is for a better quality of total earnings to our investors in Polar PLC, because performance fee profits can be variable. And over time, we are seeking, as a function of going more into the institutional side of the business through segregated mandates, which have arrived, a number have arrived over this first half of the year. What we will see is hopefully a more longevity of relationship with clients increasing, and that will allow our core earnings base to increase versus our performance fee elements of our total earnings. And what that should allow us to do is really link our distributions to investors more directly to core earnings. Now, with the expansion of core earnings for this first half year, has given us the confidence to filter that through into our dividends, which I'll discuss in more detail when we get to the dividend slide. But you can see at the bottom of this slide here, the dividends per share up to 14p compared to the 9p last first half. Now, looking at the operating costs of the business, when you look at the operating costs as a standalone line, they have increased significantly compared to the first half of last year. But that is a function of a couple of things happening. One is that the two acquisitions that we conducted last year both fell into the second half of the year. So both the Dalton acquisition and the Phaetian transaction are not in that comparative line of 30th of September 2020 that you see on that slide there. What that means is period on period, first half of last year compared to this year, our headcount has gone up roughly 23%. And that is the reason why staff compensation costs, when you look at the first half of last year versus this year, are up significantly. But the key is that we run a profit sharing model whereby the teams participate in the profits of that they help generate for the organization. So as profitability increases, the compensation element also increases. However, the key is that we are able to increase over time the core operating margin of the business to really leverage the business. And you can see that 39% for the first half of this financial year, and our expectation for the full year is that core operating margins will be 37%. That will be an expansion from last year's 36% in effectively a year where we have done two acquisitions, and as Gavin mentioned earlier, over this first half of this financial year, looked to take on another team, the sustainability team. So all in all, a really positive indication of maintaining good cost discipline and growing the core margins there. This provides a detail on other operating costs or non-compensation related costs of the business. And really the key message there is, if you consider that line before exceptional costs, other operating costs of the business, such as the Bloomberg charges, the IT charges, and rent and rates, etc., have stayed fairly consistent. The exceptional items, just to briefly indicate and explain what those are. When we announced the acquisition of the Dalton business February this year, so just pre the March 21 financial year, we indicated that we expected reorganization costs as a result of that acquisition to be around £6 million. We recognized some of that cost in the financial year 2021, so March 2021, and the remainder have fallen through into this financial year and over this first half. We expect the total cost, once we're done and we are we've completed that transition of that business, to end up roughly at the 5 million mark, so much lower than we originally anticipated. Moving on, we look at the balance sheet side of the business, and really this slide gives you an indication of our cash and our seed investment holdings. And the seed investment holdings are essentially where for newly launched funds or nascent funds or funds and strategies that we're looking to grow, Polar invests some of its cash on its balance sheet into the funds to allow the funds to post a track record to enable us to attract external investors, and also to provide the initial capital for other investors to come in and invest alongside us, and thereby over time grow the funds. So period on period, what's happened there is that we have effectively redeemed seed money out of the Asia Stars Fund. So that is the second fund by the Emerging Stars team that has reached scale. It is now above 100 million sterling. So we've taken that seed money out and recycled it into the two new funds that we've launched for the new sustainability team, Smart Energy and Smart Mobility. And also a little bit has gone into the restructured Forager team that Gavin alluded to earlier, the team that has been around but restructured as part of the second generation of managers leading that team. So overall, at the end of September, we supported 8 funds that we are looking to grow over time. A quick look at the capital position of the group, and on the right-hand side of the slide, you can see that a surplus capital position of 70 million over regulatory requirements and the dividend that has just been declared. And the other key thing that I would point out is just really the way we look and think about capital is set out under that on the left-hand side towards the bottom of the slide under our framework for use of capital. And we really see 4 uses of our capital. One is to really continue and grow the seed and continue to seed new product ideas, because that is really the R&D side of the business. So as the business grows and we launch new teams or existing teams launch new products, we will continue to back those ideas and products. We will continue to use the strength of the balance sheet to not only protect against market shocks, which seem to be happening more and more, but also to allow and provide for a buffer to provide an underpin to distributions to shareholders. And of course, we use the balance sheet to return capital to shareholders through our ordinary dividends. And finally, we do have a share buyback program that is in place in the background that works through our EBT, and it seeks to dampen the impact of group share incentive schemes that are in place. And finally, to round off the dividend policy of the group, as a reminder, the first interim dividend for any financial year is a very mechanical calculation. We look to pay out 50% of the first half of each year's core earnings. So core earnings at the September 21 mark were 28p, and therefore the first interim dividend really kicks out as a mechanical calculation. So half of that, 14p, was declared recently. When we think about the full year and full year's earnings, we have a range of 55% to 85% of total adjusted earnings that we seek to place any given year's dividend within that range. And the reason for having that range is recognizing that because we do have performance fee profits as part of our overall mix of P&L and earnings, those profits can be variable. A case in point being the profits from last year versus the lower profits this year. And that range really allows us the flexibility to, over time, as this slide hopefully shows, grow the dividend in a sustainable fashion. And as you can see, over the last 3 to 4 years, the total dividend has grown at a CAGR of roughly 13%. And in terms of looking at and looking ahead to the end of this financial year, a key takeaway is really the fact that despite the fact that performance fee profits will be lower this year, we can really see that there are core earnings, expected core earnings for this full financial year that are enough to underpin last year's dividend and really look at with confidence that second interim dividend and have a little bit of a headroom to potentially increase that once we get to the end of the year and see what the economic environment and the position of the group really looks like. So, but the message is that there is enough confidence and there are enough earnings for us to be towards the higher end of the range, dividend range this year before we even consider performance fee profits. Gavin, with that, I'll pass back on to you. Gavin, you're on.
Thank you, Samir. So I think just rounding up then, a key focus for us at both Polar corporate level and within the funds is obviously sustainability. So ESG, as you all know, is becoming increasingly critical in how we actually manage the business and our underlying portfolios. Now, I won't go through all the detail there. You'll see this presentation yourselves. You can go through it. But essentially, we've had to build a central team focused on supporting our 16 investment teams in terms of what they do with ESG. The governance we've always been pretty good at. I think the shareholder engagement, because we are active managers, we've been very, very good at that as well. But obviously, climate-related issues are increasing the burden of our fund managers, and obviously the whole scope 1, 2, and material scope 3 carbon footprint baselining is important. So that's been undertaken for Polar at corporate level, but increasingly we're starting to look at our portfolios to make sure we understand what our portfolios look like in terms of their carbon footprint. In terms of societal impact, we have initiated a number of projects. One is a partnership with an academy, a school in Westminster, where we're providing funding for laptops for students, also bursaries for students to get to university. And that's really to try and address diversity within our sector and try and improve diversity, both gender, ethnic, and of course social background as well. So that's a very important partnership for Polar Capital. On the next slide, I'll talk a little bit more about the team that joined us in September. A 14-year track record led by TMO Lam. The team will be based in Zurich, although at the moment they're operating out of our London office, and they were managing 5 billion euros at their previous company. So it's a very, very strong track record over a long period of time. And of course, sustainable investing is in their DNA. This is not new for them. This is something they've done for a long time. For those of you who follow this is an Article 9 fund in terms of SFDR. So it really does invest in companies that make a positive impact on the environment and climate going forward. So a very exciting opportunity for us, providing, as I said earlier, £9 billion of capacity. And the key for us now is to try and grow the AUM for this team as quickly as possible. They will be the team have been servicing our client base in the past 10 years or so. So there is no need for our clients to really, I suppose, be introduced to this team. They are already aware of the team. So that gives us confidence that we should see flows in the imminent future. Moving on, we've also diversified our distribution, so our sales and client servicing capability across the globe. Historically, Polar has been dominant in the UK and less so in the continental European markets, but that's increasingly we're looking at both Asia and the US. And on the left-hand side of that chart, what I've done is I've listed down the addressable market sizes, not to really put down big numbers, but just to show you what the relative sizes of the markets are across the globe. So, North America, double the size of Pan Europe, and of course Asia, ex-Japan and Australia, so developing Asia, $14 trillion, and Japan and Australia, $8.5 trillion. So, if we can try and get very small market shares in those very, very large markets, that'll do a lot for our business in terms of diversification of our client base. 4 very experienced salespeople in the US now, 2 on the East Coast, 1 on the West Coast, 1 on the Midwest. Europe, we now have 13 salespeople covering 8 core markets, including the UK. Tremendous progress in the Nordic region over the last 2 years. And of course, Asia has been a big focus. So from 0 3 years ago to over $2 billion in Asian AUM. For us is good progress, and we will be opening an office in Singapore early in 2022. We have also recently taken on an Australian superannuation mandate, which is our first one into that very, very growing pension fund market in Australia. So then to conclude, and we can then respond to questions, to summarise, a very strong balance sheet to support growth in seeding. and to support a growing dividend as core profits grow. A continued focus on capacity and performance. Again, just to reiterate, £38 billion of remaining capacity. The Sustainable Emerging Market Stars team, through their 3-year track record now, those are Article 8 funds. Those are now receiving very, very good daily inflows. So they've got through critical mass of £1 billion. So we have a highly differentiated, actively managed portfolio, which is what clients want. Increased diversification regionally gives us new markets to address. And of course, our more recently launched funds are providing most of the growth in AUM. So you can see over time a much more even spread of AUM across the overall group and much less single fund concentration risk. So on that point, very, very happy for Samir and I to respond to any questions you may have.
Thank you to you both for that helpful run through, and we've got some questions coming in. Let's start on the dividend. Do you have any thoughts of altering the dividend programme to perhaps include a monthly or bi-monthly payment? There's a view that it might attract some investors seeking income.
Samir, shall I take this? The short answer to monthly is no. We haven't had any thought on that. I mean, I think we'll stay with 2 interims a year, so first and a second. What we will do though is narrow that dividend payout range to give more certainty as to what the dividend prediction could be. So I think that is absolutely key. Because earnings have been in the past heavily influenced by performance fees. Likewise, the dividend has been unpredictable. So we're getting much more focused predictability of dividends. But certainly the thought of paying a monthly dividend it hasn't been tabled yet.
Okay, thank you. For a new shareholder, could you perhaps please explain the crystallisation process for the differing funds?
Yeah, so when teams joined, and they all participated in a preference share program whereby they acquired preference shares in the holding company, and over time, essentially after 3 years of being with us, they could actually convert those preference shares to ordinary Polar shares in return for giving up some of their profit share. So essentially, it was a method whereby they could sell back to the PLC some of their profit share for that team, and that gave them an equity holding in the group. And that term of converting prefs to ordinaries is what we call crystallization. It's earnings enhancing for shareholders because essentially we are issuing shares in return for an enhanced profit coming out of these teams, and going forward the teams share in less profit in their own silo, if you like, and our shareholders benefit from this. So that's the crystallization. So over the years we've had crystallizations coming through. New teams going forward, we've altered the way the teams are equitized within Polar. We just find there's a more efficient way of actually achieving that. So they effectively take some of their revenue or profit share as Polar equity, and that's how they receive equity in Polar Capital.
Okay, thank you. Obviously, there's been a huge growth in interest in ESG funds. Are you finding this increased competition is going to provide headwinds for your new strategy?
I think yes. I mean, most fund managers, all fund managers, in fact, are focusing on sustainable investing. I think everybody has to face the real catastrophe going forward on this planet. And I think COP26 really sort of brought it to a head. But yes, of course, there'll be increasing competition, as there always is. And I think you've just got to be better than your peer group at what you're doing, which is why the emerging market sustainable team that joined us summer of 2018, they had a long track record of sustainable investing in emerging markets. So we've got the head start there. We're not building a new capability. We're not waiting to prove the team. It's a proven team. And likewise, the team that joined us in September this year, a 14-year track record of sustainable investing right within the DNA of what the team does, and fully understood by their investor base going back. So yeah, with that, what we are saying is we have the experience, we have the track record, and we've housed these teams within an environment of Polar which allows them to flourish and to really perform for their clients. So yes, the short answer is there will be more competition, more sustainable funds will come on board, but we've just got to perform better than the peer group.
And can give us a sense of how marketing is going at the moment for the new team?
It's going very, very well. I think we've had a lot of interest. I think the headwind will be the size of the individual funds, because that will limit the ticket sizes that investors can put in. So we're seeing daily inflows, but they are small because the fund sizes are small. As those funds grow in size, the ticket sizes will get bigger. I mean, typically an investor would not want to be more than 10% of any particular fund. So, the larger the fund, the more they can put in. And clearly the team were managing 5 billion euros. We never try and predict what percentage of that client base will move across. We build them from scratch. But very, very encouraging in terms of the marketing for that team.
Can you talk a little further on what you see as future opportunities for M&A and consolidation from Polar?
Okay, so Samir spoke about two acquisitions or two transactions last year. Polar is not, our strategy is not built around acquisitions. So we're not an M&A boutique that tries to grow its business through inorganic M&A growth. What we're seeking to do is grow our shareholder returns at the same time as diversifying. And the reason we're diversifying is to try and reduce business risk, because these businesses are very, very correlated to equity markets, and there is risk there. So we try and, through diversification, reduce that risk, and that's how we grow. If to achieve that growth and diversification objective over the long term, we see an opportunity that presents itself as an acquisition, we will look at it. But we don't look at acquisitions per se as a strategy. So the Dalton acquisition last year was, we were very, very interested to add excellent European equity team to our portfolios. A number of teams at Dalton, very, very good. An outstanding sales team that gave us a new market, the German institutional market. And for those reasons, it made more sense to acquire Dalton in its entirety and take the teams on. That way we retained the client base, we retained the staff we wanted, and that made sense. But typically our model is to try and find talent to manage a specific equity asset class, and then try and lift them out and get them to join us. That is much more the route we'd rather go. It's lower risk, and it's easier to build a culture around those teams that you add on.
Thank you. And well, to your point then on culture, we have a question here on whether you're all back in the office. Are you there full time, and what's the view of how you'll run the office going forward?
Okay, well, clearly today I'm not in the office. I've got my two Messiah guardian angels behind me, but we are back in the office. I would say all of the staff, so we've got 190 odd people at Polar Capital. I would say in London, where most of the people are, we are all back at least 3 days a week. Typically Polar always did have a reasonably flexible working environment. So Fridays was always a day where staff caught up at home, didn't commute in. Increasingly we're seeing more people coming in on Mondays, but for us it's vital that people get back together again. And for me, during lockdown, post the pandemic, it was all really finding ways to avoid culture dilution, because a firm like ours really does rely on the people, and it's the interaction, it's the collaboration of those people, and that there's no doubt that is far better in a face-to-face environment than it is over screens. It's curious, this roadshow, these results, we had half the total presentations face-to-face, the other half, such as this one, are just much more efficient via Zoom or any other medium. It's just way more efficient to do them this way. So I think we're getting the best of both worlds in terms of how we take this business forward. But no, definitely all in the office, finding reasons to get together, finding reasons to go and visit companies and engage with them again on the shareholder engagement, finding reasons to go and see our key clients in Europe. But not everybody wants to see us. I mean, I've had quite a few shareholders this time around saying, Gavin, we know what you look like, we understand the business, we're quite happy just zooming in.
Flexibility is key, hey?
Exactly.
I think our research note probably points a little bit to this question, but I shall pose it and see what response you'd like to give, just around the large share price discount compared to your peers, and how and why do you see will be the factors that would trigger this narrowing?
I mean, a number of reasons. I mean, the share price is underpinning a very high dividend yield at the moment. So you can see the balance sheet strong, the dividends well covered. I suspect the share price at a discount to our peers is probably reflective of liquidity in the shares. It's fairly tightly held, fairly high level of our equity is held by staff and key people. And I think the other thing is there may be a concern about technology concentration, which has been the heritage of the business. And as we diversify more and more, I suspect we should start seeing that discount narrow against our peers and in fact turn into a premium. The share price has moved a long way in the last couple of years as the business has developed. So whilst its current positioning is at a discount, I think that provides a fantastic opportunity for shareholders to come into a business that really is showing traction and diversification coming forward. And certainly, I know I can't sort of do a big sales pitch here, but I'm a buyer of shares at the current price.
Thank you. This question actually just probably leads on from your earlier one to dividends, so has slightly been covered, but they're taking the opposite view. Rather than why aren't you paying out more frequently, it is why are you paying out at all? Is it not going to be better for the growth of the business to reinvest and perhaps more tax efficient too?
Yeah, I mean, I think a lot of our shareholders actually look to income, so they do rely on the dividend income coming out of Polar Capital. Businesses like ours are not capital intensive, so you don't need to use a lot of your free cash flow that you generate every year to actually reinvest in the business. And certainly, Samir's slide on the framework of the capital allocation, we've always got more than enough to seed and fund R&D, research and development for new teams coming in. So I get this question all the time from those shareholders who are purely growth investors who are saying, Gavin, just reinvest and grow the business faster. But then on the other hand, I've got the other shareholders who are saying we actually quite like, the 5% yield that you're providing for us at the moment. So, you've got to try and balance the two.
No, very sensible. Well, that seems to be it from questions from us. So thank you both again for sparing the time today. And we look forward to hearing another update in 6 months' time. Best of luck in the meantime.
Thank you very much. Thank you all.
Thank you all.